Welcome. Today we are going to talk about stocks that are close to their 52-week high or have hit their 52-week high and whether you should be buying them. Or sometimes you could already be holding them and you wish to accumulate positions in them, but you're wondering whether you should do it because they're already run up, right? So at Prime Investor, we have our set of prime stocks where we give recommendations on them, and we often are, asked this question that the stock that we still have a buy on is rallied quite up and is nearing its 52-week high. Why are you still having it in your buy list? Or should I even be buying it now, right? So there are times when the 52-week high is not, something very sacred, So there are reasons why a stock may well move past its 52-week high. 52-week high, after all, is just, a record of the highest price that a stock had over the past 1 year. And it's quite possible that the stock moves upwards for various reasons. So understanding when a stock can really break out, even in technicals, they call this breakout. Sometimes when, stocks have hit their 52-week high or have very high momentum, technical analysts actually prefer those stocks because they know that they can break out and create, new highs for themselves and therefore increase, the potential of those stocks. But fundamentally, let's look at the reasons why these are happening, right? So one of the primary reasons, now I'm just quoting this article written by my colleague Chandra Chodamani. He has in detail covered, when you can actually buy stocks over a 52-week high and why you should not even be averaging those that are probably low. So we'll discuss about it. So the first reason why a stock can, very well move beyond its 52-week high is when a sector is in the limelight in the market. That is, the market fancies a certain sector. If you take at the present time, consumer discretionary stocks are moving higher and higher in that space. You can see capital goods. In the past 3 months, we have seen a lot of capital goods sector, stocks in the sector, and also in the banking space. A lot of corporate banks, as credit growth moved to double digits, many of the corporate banks started gaining, right? And because these were languishing low for a very long time, naturally when they move, they easily go past their 52-week highs. So this does not make these stocks irrelevant anymore or that they are overvalued, as long as that growth momentum in their earnings continues to be there. So in these cases, you might actually be missing out on a significant rally if you avoid those stocks just because they are nearing their 52-week high. The other thing, obviously, the first point is backed by the fact that there is robust earnings growth. Banking sector saw this. Once, the NPA cycle entirely bottomed out, you could see significant earnings growth in banks across board, and this led to a quick re-rating of these stocks. Naturally, they had moved past, and they were making new 52-week highs actually. So in these instances also, when there is a turnaround, after a very bad phase in earnings, when there's a turnaround, stocks can quickly break out of their 52-week highs. The other thing is, certain stocks can undergo revaluation, re-rating in the market for certain reasons, just to give, our own example, the recommendation that we made in Bajaj Holdings in May 2021, the stock began hitting a new 52-week high almost every month for the next 6 months, We were actually wondering, what was, it's moving quite fast, but then we realized the stock was actually at a deep discount when we gave, and we were quite aware of it. So naturally, when that quick move happened, it seemed like the stock was moving too fast, and quite a few investors asked us whether it's okay to take positions. Those who took positions in the stocks also made money in spite of the stock, hitting new highs every month. So broadly, these are the reasons why a stock can cross a 52-week high. So when at Prime Investors, when we put a stock in prime stocks and when we think the stocks are moving for any of these reasons, we will continue to maintain them in their buy list even if the stock had run up significantly. It basically signals that you still have upside potential left in those stocks. So you need not shy away from taking positions in those stocks. Now, having said this, there are also times when, stocks trade below their recommended price. Some of our stocks or some of the stocks in your own portfolio might actually be lower than the price you bought. You immediately think that you need to average, right? It is okay to average, but not too often. First of all, when a stock starts falling, you have a thesis, you buy the stock. If the stock falls along with the market, it is fine. But if the stock is a loner in falling while the rest of its peers or rest of the market is going up, you need to think a bit about why the stock is falling. And we do that at Prime Investor. Some of the stocks that we give fall, and if we have conviction in the thesis that we have given, we do give even average calls. So it's okay to average it once or so, but continuously buying the stocks that are falling in your portfolio and not touching the ones that have moved up basically means you're not building positions in your winners. You're building positions in the losers, believing that they will all turn out to be winners. That may not happen sometimes, right? And we have had, one such, recommendation where one of the group companies, in the Tata, we had to issue an exit call because we knew averaging downside in that case. It is a case of Tata Steel Long Products. It won't work because we understood that there was going to be some kind of consolidation happening. So no point in trying to continuously average because they have fallen. This doesn't mean that if we have given a buy call and it has fallen, you should not average, but even averaging needs some substantial, fall for you to meaningfully average. That is one point. The second point is, don't just average this stock alone. When there is a market fall, you see some of your winners also falling a bit. If you have surplus, do accumulate the winners as well, irrespective of the fact that they may be at a 52-week high, provided you see any of these 3 points that I mentioned playing out, that a sector is in favor, that earnings growth is very strong, or for a certain reason a stock is undergoing revaluation. Bharat Forge, for example, significantly saw a change in its entire business, in the way it revamped its business. It widened, diversified, it had organic growth, it saw significant re-rating, right? So you need to kind of understand why a stock has moved to a new high and whether it can sustain. So there is no real rule that sell the 52 weeks high and buy the 52-week low. In fact, you might be harming your portfolio more than helping it. All the best.